Accounting might not be the most exciting part of running a business, but it's one of the most critical. Many small businesses lose thousands every year, not because they aren't profitable, but because of avoidable mistakes. From misreporting expenses to flying blind on your cash flow, these errors add up quickly and lead to IRS penalties, missed tax deductions, and bad decisions. Let's go through the 7 most expensive accounting mistakes I see all the time, and more importantly, how you can fix them today. Mistake number 1 is mixing personal and business expenses. It's one of the most common rookie errors. Maybe you just use whatever card is in your pocket at the time, or maybe your business isn't making money yet, so you put everything on your personal card. But here's what happens: you end up with a messy paper trail, expenses that may not qualify as deductible, and if you're operating as an LLC or S Corp, you might even compromise your liability protection. Also, during tax season, separating those mixed transactions can take hours of manual work and drive up your accountant's bill. Worst case, it triggers an audit. So, how do you fix it? Start by opening a business checking account. Tools like Relay and Mercury are excellent options. Relay lets you open multiple checking accounts, assign virtual and physical cards to team members, and track spending by category. Mercury is another great fintech platform, especially if you're a startup founder or run an online business. To open an account, you'll typically need your EIN, which you can get for free from the IRS, your LLC formation docs, and a business address. Both Relay and Mercury have online applications and often approve accounts within a few days. Once you're set up, make a clean break. Only use your business accounts for business activity and don't let the two worlds overlap. Mistake number 2 is skipping your bank reconciliations. It sounds boring, but it's how you know your books reflect reality. Without reconciliation, a charge may be counted twice, a deposit might go unrecorded, and your reports become fiction. Reconciliation simply means matching what your accounting software says happened against what your bank actually processed. Use QuickBooks or Xero to automate most of this, but don't just click match blindly. Review each line item, especially for high value transactions. To make this stick, set a recurring reminder. Say the first Friday of each month. If you're too busy, delegate this to a bookkeeper or train a trusted assistant to handle it. Mistake number 3 is doing your own books without knowing what you're doing. Accounting software makes it look easy to plug in numbers, but it's just as easy to create costly errors. Misclassifying an expense or recording income in the wrong period can distort your tax return and financial reports. The consequences? You might overpay taxes, miss legitimate deductions, or think you're profitable when you're actually losing money. I've seen lenders reject business loan applications because the financials were inaccurate. If you want to do your own bookkeeping, start by taking a short course on platforms like LinkedIn Learning, Udemy, or your local small business development center. Learn about expense categories, accrual versus cash accounting, and basic financial statements. In your accounting software, set automation rules, like always classifying Adobe as software or FedEx as shipping, to keep things consistent. Mistake number 4 is letting your books pile up. A month goes by, then 2, and suddenly you're trying to categorize hundreds of charges with no memory of what they were. When businesses fall behind on bookkeeping for several months, it becomes much harder to remember what a charge was for or locate a receipt. Expenses go unclaimed, and accountants often need to spend hours cleaning up the data, which can mean higher prep fees and rushed, error-prone tax filings. Solution: set a recurring 30-minute slot each week just for bookkeeping. Use a receipt capture tool like Dext or QuickBooks' mobile app to log receipts in real time. If you hate doing it or can't keep up, hire a part-time bookkeeper through platforms like Upwork or Bench. Bookkeeping isn't optional, it's foundational. Mistake number 5 is not managing both your receivables and payables. On the receivables side, missed invoices or no follow-up means delayed or lost revenue and unpredictable cash flow. On the payables side, late payments trigger fees, harm vendor trust, and can hurt your credit. The fix? Use software to track both sides in real time. For AR, send invoices promptly, set reminders, and review your aging report twice a month. For AP, log due dates, pay early for discounts, and batch payments so nothing slips through. Managing both together keeps your cash flow steady and your business running smoothly. Mistake number 6 is using a messy chart of accounts. It's not uncommon for businesses to create overly detailed or vague expense categories, like having 15 different categories for meals or using other as a catch all for dozens of unrelated transactions. This makes your reports useless and frustrates your tax preparer. It can also lead to misreporting if your categories don't align with IRS forms like Schedule C or 1120S. Fix it by downloading a standard chart of accounts for your industry. QuickBooks and Xero both offer built-in templates. Customize it for your business, but avoid overdoing it. Think big buckets: revenue streams, COGS, marketing, office, software, travel. Eliminate redundant or vague categories. Keep it clean, clear, and useful. Finally, mistake number 7 is not reviewing your numbers regularly. It's one of the most critical errors because it doesn't just affect your taxes, it affects every decision you make as a business owner. If the only time you check your profit is when your CPA files your tax return, you're missing major opportunities and risking your business's financial health. Without routine reviews, you don't know if you're profitable, if you can afford that new hire, or whether your marketing is working. You might be spending thousands more than you realize. Every single month, sit down and review 2 reports: your profit and loss and your cash flow statement. Ask yourself key questions like: am I profitable this month and year to date? What's my runway if revenue slows down? What expenses went up and why? You should also track at least 3 KPIs: net income, cash on hand, and gross profit margin. These give you a snapshot of how sustainable your business is and how much you're keeping after costs. If you're a visual thinker, tools like Fathom, LivePlan, or even Excel dashboards can help. And here's a bonus tip: make it a recurring meeting on your calendar on the last Friday of the month, for example. Bring your co founder, partner, or advisor into that meeting. Make it a ritual. Now, let's break down what these mistakes actually cost in real dollars, not just theory. Say you miss $5,000 worth of mileage, home office, or software expenses. That could result in over $1,100 in unnecessary taxes, depending on your tax bracket. Or maybe you underpaid your quarterly estimated taxes by a few $1,000s. The IRS charges both interest and penalties, often adding $500 to $1,000 or more in surprise fees. And then there's unpaid invoices. If 4 clients each owe you $800 and no one follows up, that's $3,200 left on the table. Money you earned and never collected. These aren't rare cases, they happen all the time, and they chip away at your profits silently month after month. Here's a quick recap of how to avoid every mistake we covered and turn them into sustainable habits. Start with separating your accounts. Open a business checking account with Relay or Mercury. Both offer easy online sign up with your EIN and LLC documents. Next, reconcile monthly. Don't rely on your bank balance alone. Match transactions inside QuickBooks or Xero to your statements. Learn the basics of bookkeeping. Take a simple course or schedule an hour with a CPA to review your setup. It's worth it. Stay on top of your books with a weekly routine. If you can't do it yourself, use tools like Bench or Dex to automate or delegate. Always track your receivables. Use an aging report and send automated reminders. It's not real revenue until it's paid. Keep your chart of accounts clean and aligned with IRS tax forms. Use broad categories and avoid redundant or vague names. And finally, review your numbers monthly. Look at your P&L, your cash flow, and 3 key metrics: net income, gross margin, and cash on hand. All 7 of these mistakes are common, but every one of them is fixable, starting today. Even implementing just 2 or 3 of these solutions can save you thousands and give you clarity on how your business is really doing. Accounting isn't just about avoiding penalties. It's about having the confidence to make smarter decisions, invest in growth, and sleep better at night. Thanks for watching, and I'll see you in the next one.